Welcome everyone. Thank you so much for joining me. Please consider subscribing if you haven't already, and make sure that you ring the bell to turn on video notifications. Retirement is supposed to be a time to unwind. Maybe you're traveling more, maybe you're spending longer afternoons with your family, joining friends for dinner, rediscovering old hobbies, or finding new ones that you never had time for. And when life finally slows down, it is natural to assume that your chances of being audited by the IRS slow down too. After all, you're no longer juggling a full-time career, your taxes are usually simpler, and you're certainly not filing complicated business returns that, of course, increase your chances of being audited. And in general, you might be right, but that doesn't mean that retirees are completely in the clear. The IRS has billions of extra dollars dedicated to enforcement, and it means more resources for examinations, more technology scanning tax returns, and more opportunities for your return to catch the agency eye. So the truth is, retirees can and do get audited, and certain actions, mistakes, and omissions can dramatically raise the odds. Today we're breaking down 5 of the biggest red flags that can draw IRS attention, and we will also discuss what you can do to avoid them. Let's begin with the one that gets more taxpayers into trouble than anything else: failing to report all taxable income. Whether it is wages, dividends, pension payouts, IRA distributions, or Social Security benefits, every reportable payment that you receive shows up on a form that also goes directly to the IRS. That includes 1099-R forms from retirement accounts, SSA 1099 forms for Social Security, and even 1099-K forms for payments from platforms like PayPal, Airbnb, Etsy, and other third-party networks. For 2025, you will get a 1099-K if you received $2,500 or more for goods or services. Yes, it is a very low threshold. This is the lowest it's been in years. When the IRS receives these forms, its systems automatically match them to the income that you list on your tax return. And if anything is missing, or if it is mismatched, the computer flags it and triggers a notice. So this is why it is essential to report every single dollar. Even if you never received a form in the mail for it, you still need to report it if it meets income criteria. Leaving something out is the fastest way to get that unwelcome letter from the IRS. The second red flag is claiming deductions or losses that look unusually large compared with your income. For example, if you have a large medical expense that suddenly wipes out a big chunk of your taxable income, that can draw attention from the IRS. If you sell rental property or investments at a significant loss, that can also raise eyebrows, especially if the loss offsets your income from pensions or from Social Security. Even deductions for bad debt or worthless securities can prompt a closer look, particularly when they are reported as ordinary losses. But here's the key thing to remember. If the deduction is legitimate and you do have documentation to support it, don't be afraid to claim it. You should claim it. The IRS may ask questions, but you should never leave money on the table just because you're worried that the IRS may look twice. Next up, let's talk about gambling winnings and losses. The IRS treats gambling income just like any other taxable income. Recreational gamblers report winnings on their 1040. Professional gamblers list them on Schedule C. And if you win big enough for the casino to issue a W-2G, trust me, the IRS will definitely see that. Where retirees often get into trouble is with losses, and that's what I will focus on in the next several minutes. You're only allowed to deduct gambling losses up to the amount of your gambling winnings. That's the rule. If you claim losses without reporting any winnings, or if you claim unusually large losses, expect a second look from the IRS. The IRS especially scrutinizes taxpayers who list gambling as a business activity because they want to confirm that these individuals truly qualify as professional gamblers, not just people trying to write off their losing bets effectively. The fourth red flag involves required minimum distributions. Once you turn 73, which will change to 75 beginning in 2033, you must start withdrawing a certain minimum amount from your retirement accounts each year. The IRS keeps a close eye on these accounts because they know that many seniors forget or misunderstand these rules. And the penalty for missing a retirement distribution can be quite steep, up to 25% of the amount that you should have withdrawn. So definitely don't forget to withdraw your money. The rules are even more complicated for inherited IRAs. Many non-spousal beneficiaries of an IRAs inherited after 2019 have new requirements and deadlines for taking withdrawals. So if you're not sure whether you're required to take a distribution or how much you're required to withdraw, it is worth consulting a professional so that you don't get penalized later on. Errors in this area attract IRS attention quite quickly. And then there is the opposite issue, taking money out of your retirement account too early. Distributions from IRAs and 401ks before age 59 and a half are generally hit with a 10% penalty unless you qualify for an exception. And the IRS knows that many taxpayers misreport these distributions or incorrectly claim exceptions that don't actually apply. The IRS publishes a detailed chart of which exceptions qualify. Some apply only to IRAs, others only to workplace plans, and some do apply to both. If you're taking money out before age 59 and a half, you need to be very, very precise. Incorrectly avoiding the penalty is an easy way to draw the IRS attention. So these are just some of the biggest audit triggers facing retirees. While your overall chance of an audit is probably quite low, certain mistakes or omissions can dramatically increase the risk. The best defense is staying organized, double-checking your forms, and keeping good records. Retirement should be a time to relax, not worry about the IRS, but a little awareness actually goes a long way in this regard. Stay tuned for new updates. I upload videos on a weekly basis, and if you have any specific tax questions, leave them in the comment section below. I do read your comments and I would love to hear from you. Remember to subscribe, share my videos if you find them helpful and informative, enable notifications by ringing the bell, and I will see you back here soon. Take care.